First-time buyers are disappearing. Listings are thin. Payments sit at all-time highs. And now a new pitch shows up in inboxes across the country. Stretch your mortgage to 40 years and the monthly drops. If relief is that simple, why does the market still feel welded shut? Most new buyers face record monthly costs with fewer homes to choose from. This isn't a story about list prices behaving badly. It's a story about a single number that decides your life, the all-in monthly. In the next few minutes, we're going to follow one almost buyer, map the choke points that keep the first rung out of reach, and pressure test the longer mortgage that seems to solve the problem. By the end, you'll be able to tell the difference between real relief and a red flag in seconds. Meet the almost buyer. Years of saving, a clean pre-approval, the kind of starter home you used to see every weekend. Small yard, tired paint, decent bones. The listing price looks survivable. Then the real number arrives. Principal and interest are only the opening act. Add property taxes that reset after you buy. Insurance that's not what the listing assumed. HOA dues that can change on a vote, plus a maintenance reserve that isn't optional if you plan to sleep at night. The headline was the price. The story is the payment. Here's a line you can repeat. Most renters clear the deposit, then hit the monthly wall. Surface the hidden add-ons now so you aren't blindsided at closing. Naturally, the almost buyer asks the next question. If I'm ready and qualified, why are there so few shots on goal? Inventory is thin, and here's why that won't change quickly. Millions of owners locked in ultra-low mortgage rates a few years ago. Selling now means swapping a tiny fixed cost for a bigger one, even if the new house is the same size. Faced with that math, many owners keep the old place and rent it out, then go rent where they're moving. Turnover falls, listings shrink. The starter home shelf looks empty, not because demand disappeared, but because the other side of the trade refuses to list. Locked-in owners don't list, so entry-level buyers don't enter. That's how you can read prices cooled and still watch your payment quote climb. Median sale prices can drift down if the only homes trading are smaller or cheaper. But affordability doesn't live in a median. It lives in the share of your take-home swallowed by the total monthly. If that share is rising, the market is tightening, no matter what the headline says. If a metric ignores the monthly, it ignores reality. The shelf thins, and first-time buyers age up. People wait longer, save more, and step in later. That bigger down payment helps, but there are fewer years to amortize the debt. Others pause life plans altogether. Roommates for longer, moves delayed, job offers in pricey cities declined. The market isn't just rearranging addresses, it's reshaping timelines. At this point, the pitch arrives. When a 30-year won't fit, try 40. Extend the term, lower the monthly, cross the underwriting line. Sometimes it's just enough to turn a no into a yes, and that green light can feel like oxygen. When a 30-year won't fit, some lenders pitch 40. It shrinks the monthly so you can qualify, but it stretches your risk timeline. And that's where pressure builds. The longer term changes the feel of month 1. It also changes the math of years 1 through 10. With more years, more of your early payments go to interest, not principal. Equity builds slower. Total interest paid collects like barnacles on a ship. If life forces a move sooner than planned, a job change, a new baby, a health shock, you may find you own less of the house than you expected when it's time to sell. The longer term didn't remove the weight, it spread it across more birthdays. Shrink the monthly, stretch the risk. That's the trade. Meanwhile, the monthly you're trying to shrink is bigger than a calculator suggests. Insurance has been repriced in many regions. Property taxes often reset after purchase. HOAs and condos can levy special assessments that rewrite the year midstream. Utilities and commuting costs can shift depending on location. Those lines don't show on the listing page, they show up on your statement. Most buyers shop price. Lenders approve payments. Treat the monthly like the product you're buying. Now widen the lens. In cities where supply stayed tight, timelines stretched even further. Loans got longer. Rooms got smaller. More adults shared the same address for longer. Ownership survived, but with trade-offs you feel every day. If that sounds distant, look around. Household sizes ticking up, new homes shrinking, first-time buyers arriving later. When supply locks, time becomes the release valve. Back to the shelf. If inventory is thin, won't a dip in mortgage rates fix it? Here's why that won't change quickly. Lower rates make buying a bit easier, yes, but they also make existing owners even happier to stay put. Imagine a tide that moves buyers faster toward the same handful of houses, while the people who might list are more comfortable not listing. Unless new listings rise and stay up, lower rates alone can tighten competition without refilling the shelf. You'll see more buyers at the same open house, not more houses to visit. So what would actually loosen the market? Not a single headline. Several switches flip together. New listings need to rise and keep rising. Payments need to fall for reasons that last, rates easing, prices softening, or both, so the share of take-home required actually shrinks. Builders need to deliver more entry-level square footage, not just luxury. And ownership costs beyond the mortgage, insurance and taxes especially, need to stop lurching higher. Without those together, the bottleneck remains a bottleneck. While we wait, a quiet shift happens at the entry level. Homes that used to go to first-time owner-occupiers become rentals. Some are bought by small investors, others by larger firms. Streets tilt toward tenancy. Neighborhood stability changes. Labor mobility slows. It isn't a morality play, it's mechanics. When the front door narrows, someone still walks through it, just not always the person trying to live there. Our almost buyer stands in the middle of those mechanics, trying to decide on the only ground that matters, the monthly. There's a decision tree here, and none of the branches are magical. One branch says, use the 40-year as a short bridge. Prepay when you can. Refinance if both rates and fees make sense later. That can work if life cooperates and the discipline sticks. Another branch says, press pause, keep saving, keep watching the dashboard. Step in when the shelf refills and the all-in monthly actually drops. A third branch says, take the standard term now, but buy smaller or farther out, trading space or location for a payment that lets you live an actual life. Notice the pressure in those choices. None of them solve the structural issue that created the bottleneck. They're household-level adaptations to a market-level problem. And that's the point. This video isn't promising a fix, it's reporting the forces and where they're pushing people. Let's push on the 40-year branch, because that's the one marketed as the quick cure. The first promise is true. The monthly goes down. The second promise is implicit and more dangerous. The belief that the monthly you see today is the monthly you'll feel tomorrow. In the first years of a very long loan, your equity is fragile. A surprise assessment, a roof, a job change, a family change, each of these events lands harder when a larger share of your early payments are rent on money rather than ownership. Time helps if you can stay put and steadily prepay. Time hurts if you need to move sooner than planned. What about the argument that you can always refinance later? You can if the market lets you. Refinancing requires a better rate and sufficient equity after fees. If rates cooperate and your home value holds, great. If they don't, that exit ramp narrows. That doesn't make the 40-year inherently bad, it makes it inherently conditional. It's relief that depends on tomorrow staying friendly. Now add the costs that rarely fit inside a glossy ad. Insurance premiums don't care about your amortization schedule. Property taxes don't ask whether you stretched for the house. HOAs and condos can vote in the middle of your plan. Even utilities and commuting expenses can convert into real money over time. Viewed through that lens, the monthly isn't a single number at all, it's a stack. principal and interest, taxes, insurance, associations, maintenance, transportation. The stack either fits inside your take-home with margins, or it doesn't. Here's a small but powerful frame to carry forward. Build your decision around payment to income, not price to income. Price to income tells you whether the sticker looks high relative to wages. Payment to income tells you whether the cash flowing out each month actually allows you to live. Banks already think this way. Underwriting models look at your monthly obligations relative to your income. Most buyers shop price. Lenders approve payments. If you copy the lender's lens, you end up asking better questions. Does the full stack leave room for an emergency, for a child, for career risk, for healthcare, for a life? And if you're wondering why this conversation feels different from a few years ago, return to the core. Supply froze at the same time non-mortgage costs rose, and wages didn't keep pace with the way ownership costs adjusted. That combination compresses first-time buyers from both sides. It's not that the dream disappeared, it's that the door narrowed, the hinges stiffened, and the hallway got crowded. Now let's turn pressure into clarity. The market loosens when two things happen together. The shelf refills and the stack shrinks. If new listings rise and stay up while payments truly decline, the first rung lowers to human height again. If only one of those things happens, the bottleneck persists. Lower rates without listings, more bidders, same houses. More construction that misses the entry level, supply on paper, not in life. One lever moves noise, two levers move lives. So if you're in the almost buyer camp, what do you do with this? You can't control the levers, you can control your filter. Keep a simple dashboard that reflects reality, not headlines. First dial, new listings, not just 1 week, but a trend. Second dial, your payment to income with the full stack included. Third dial, the mix of what's being built in your region. Are smaller entry-level units actually coming online, or is it another tier of luxury? Fourth dial, the noise around ownership costs. Are insurance and taxes stabilizing or still jumping? Run your scenario through that dashboard and say this out loud. Banks approve payments, not dreams. Treat the monthly like the product you're buying. And about that longer loan, it's a tool, not a rescue. If it turns a qualified almost into a sustainable yes with margins, and you plan to prepay, it can be a bridge. If it turns a not yet into a brittle maybe, and you need everything to go right for a decade, that's not a bridge, that's a tightrope. Shrink the monthly, stretch the risk. That's the trade. Know which side you're standing on. It's also worth saying what this video isn't. It isn't a pep talk about timing the market. It isn't a lecture about lattes. It isn't a promise that some clever trick will outsmart the math. It's an investigation into why the first-time buyer ladder feels like it's missing its first rungs, and what the new 40-year pitch does and doesn't change. We've covered the human bottleneck, the inventory freeze, the metrics that mislead, and the loan that lowers the bill by lengthening the timeline. We've watched how thin supply rewrites household plans, how longer terms change equity math, and how ownership costs beyond the mortgage decide the truth. We've drawn a line between noise and signal. The market opens when the shelf refills and the stack shrinks together. One without the other is just motion. Let's condense all of that into the strongest framing question, the one filter that travels with you into any tour, any meeting, any ad. Can I carry this monthly and still live a life? If the answer is yes, with room for the surprises that always arrive, proceed on purpose. If the answer is only with a stretch, name the stretch. What does it buy you today? What does it cost you tomorrow? If the answer is no, waiting isn't failure, it's design. You're not stepping back from a dream. You're refusing to sign up for a monthly that would smother the rest of your life. First-time buyers aren't gone, they're bottlenecked. Payments matter more than prices. Supply, thaw, and payment relief must happen together for the latter to lower. Until then, clarity beats optimism. Build decisions around the full stack, not the sticker. Track signals, not slogans. And when you're tempted to fix an inventory problem with a time trick, remember what you're really trading: today's relief for tomorrow's timeline. Next up, does OpenAI expect a government bailout? OpenAI has signed eye-popping infrastructure commitments, figures that dwarf most industries. How do they plan to pay for them? Are taxpayer-backed guarantees the next step? In the next video, we'll dive into the financing gymnastics behind the AI build-out, the push for federal support, NVIDIA's warnings on energy and capital, why AI could strain power grids, and whether we're inflating an AI meta bubble that every investor needs to understand.